time now for the big picture. For that, I want to welcome in Kevin Gordon, Senior Investment Strategist here at Charles Schwab. Kevin, thank you so much for being with us this afternoon. Always love hearing your insight. All right, it seems like there's been some fatigue today in terms of where the market has gone. The S&P 500, top 5,500, then it came back. What's your take on what's happened?
Yeah, it's pretty much a reversal of what has been working, and then, what hadn't been working has been doing pretty well today. So in the latter camp, you've got things like energy and deeper cyclicals. In the former camp, you've got, semis are probably most in focus, but the broader tech sphere, software is holding up. But if you look at hardware and semis, those are the ones that are pulling the sector down. So it seems to be, just a reversal of some of the momentum trade that has gained a lot of traction, to say the least, over the past couple of months.
What risks should investors be watching out for then?
Well, I think, from a broader sentiment perspective, it's been interesting to see, this reversal, pretty swift reversal in investor enthusiasm. Because after, a couple of months ago, when you hit a little bit of a stumble in the April period, you didn't get a full-on correction, but you had, a 5.5% pullback for the S&P. That was enough to wash out some, optimistic investor sentiment. If you want to call it euphoria in some parts of the market, certainly not the broader market. And you had gotten back to a little bit of a better place, but now you've kind of reversed right back up to what is considered that extreme optimism zone, and it's across an array of indicators. It's not just in the attitudinal parts of the sentiment, arena. It's also in the behavioral aspects too. U.S. household stock allocations are now at an all-time high. You've got equity allocations in particular, looking, sort of at the historical record with where returns tend to go there. You were in the weaker part of that territory. So I think it's an important thing to look at, especially because across the valuation spectrum, when you bring in, price to sales, price to earnings, even earnings yields, relative to any part of the bond market, you're really looking stretched in all of those areas. We always say that whether it's sentiment, whether it's valuation, it's never the perfect timing tool, because you look at over a 1 year or 5 year period for some of those metrics, they don't tend to do well in terms of looking at forward returns for the market. It just helps explain that you're in a more vulnerable position right now when it comes to equities.
Especially sentiment. All right, let's talk about kind of some of the impact of the economic data points that we've been getting in recently. There was weaker data that we got in today in the housing sector, whether we're talking about starts, building permits, even jobless claims. Yes, they weren't as high as the week prior, but still in that 200,000 level, and continuing claims did tick higher. What does that indicate to you about the conversation that we've had in the past about a soft landing?
Well, I think for claims in particular, that's probably the main focus, because, housing has been stuck in its own form of recession, really struggling to get into recovery mode, evidenced by the home builder sentiment data out yesterday, and then also the housing starts and the permits data that you just mentioned out this morning. But claims, I think, is an important one to watch, because, week to week, it's a little volatile. So if you look at it on a 4-week moving average basis, that tends to be a better way to look at it. So even for initial claims, you have started to trend meaningfully higher, but I wouldn't say yet at an alarming rate, because we saw a similar trend exactly a year ago, where going into the summer, you started to see this steady uptick in claims. And then, of course, that reversed, lower into the end of the year. I mean, we know with the benefit of hindsight now that a lot of that layoff activity was more concentrated in the higher paying sectors. This time seems to be a little bit more broad based, but at the same time, you're not seeing the degree of the spike is not what you would see typically at the start of a full-blown recession. So I think if it's a steady, trickle higher, where continuing claims also don't meaningfully spike, probably keeps you in this, camp that we've been in with, rolling recessions hitting different parts of the economy at different times. Whether the bottom falls out, all at once, that's probably not what we're facing this time, barring some, major shock to the economy. But I think, for that reason, claims is probably the more important metric to look at when it comes to the state of the labor market, and also when trying to gauge what the trajectory looks like for Fed cuts this year, if we get any.
And then, so you just said if we get any, is the base case you're working with none this year?
No, I mean, if you listen to our chief fixed income strategist, Kathy Jones, and what she's forecasting, we're still in the camp of 1 to 2 cuts this year, presumably because inflation continues to trend lower towards their target, but you also get some pressure from the labor market too. I think both of those components need to work. And, the Fed's been very clear on the inflation front. It's not that they're waiting for, core PCE to hit 2% year over year. Powell has been very clear about wanting to, move before that's the case. They just need to be convinced that the trend is, really in that direction, which right now we're not there. But if you start to see more prints like we have in the most recent month, and it starts to look more and more like the first quarter reacceleration was more of a head fake and definitely not a reversal of the trend, that probably puts inflation on the right track. But I think also with labor starting to soften just a little bit more, that probably keeps both of those, both sides of their mandate, I think, supportive of, probably a cut or two this year.
All right, Kevin, I could always talk to you for longer, but we have time issues that we're up against now. I always appreciate your insight. Kevin Gordon, Senior Investment Strategist, Charles Schwab. Thank you, Kevin.